Okay, we're on Ford, and we're gonna try to do an educational video. Let's go to here to the 5 year on Ford. And Ford has been in the red for 5 years. Down here it was 424. If you're holding it, not good. Now look at the dates here. January 2020, April 2020. That's probably because of the virus. It went over a cliff in a wheelchair. And some people will be pretty upset about that. Okay, now if you go up here, around here it was $11. And now it's back up to $8. Let's go to 1 year. Here's where it dropped down right there. March of 2020, and it started to make a come up right here. And what we're looking for here is an opportunity to make money with the fluctuation of a stock, which is also known as volatility. Now the fluctuation is the ups and downs, like the little valleys right here, right across here. Here's a mountain and here's a canyon. And here it went up here 535 down to 436 and up to 537 down to 489. And we're trying to make money with these little chutes and ladders, shall we call them. And right here you want to buy it when it's at a low point, not when it's up here at the top of the mountain. That's not when you want to buy it. You want to buy it when it's down here. Okay, let's go to 3 months. Ford has been in the green. 1 month, still in the green. Still in the green. 1 day, probably it's in the green. So that means that Ford is maybe making a comeback. If we go to 3 months here, $6.59. And it slowly climbed up to $8.54. Down here, $8.18. Okay, 1 month. Let's go to good volatility there. Good volatility. It's down to 758. Then it went up, 10% right there. And then went up to 820, went way down to there, good time to buy it. Up there, good time to sell it, good time to buy it, good time to sell it. Good time to buy it, good time to sell it, good time to buy it, good time to sell it, good time to buy it. Right now it's up here, which looks like it's a good time to sell it. Okay, so go to 1 week. 1 week is what we want. 820, went up to 856. Then it went down to 813, up to 856. So going by the week, if we were to draw a line right across the middle of that right there, it's worth like $8.36. So if we were to buy it today at $8.55, that probably wouldn't really be too smart, because it's probably going to go back down to somewhere around $8.36. Okay, so this is a lecture on options. For options, we're going to click on trade options. Bingo, trade options. Now with option trading, you have calls and puts. Basically, the call is because you called, hey, give me 10, 20 shares of that. You're betting that the price of Ford Motor Company is going up. The put option, which is over here, I click on puts, is that you're putting it back on the market. So I don't want it anymore. Put it back on the market. Put it up for sale, or put it up for sale. Okay, now with options, you're not exactly buying the stock. It's very similar to day trading and swing trading. Day trading is you hold on to the stock for an hour or 6 hours and you sell it. Swing trading is you hold on to the stock for 4 or 5 days or a week or two and then you sell it. Which is a good way to do that. But with options, you're actually buying a contract, and the contract is a piece of paper that you hold. And we'll go to the calls. A call contract is the options are in groups of 100 or a lot of 100 or a unit of 100. Now, or a contract. One contract is 100. So let's say that you're holding a piece of paper that says that you can buy Ford stock at $8 a share. Then 10 years from now, stock is $100 a share. Well, then that piece of paper is worth a lot of money, right? Because if you sell it to somebody, then he can buy 100 shares for $8 a share. Okay, now with puts is you make money also when the stock goes down. And the way that that works is, let's say that you have a put contract, and the put contract says that I can sell this stock for $8 a share. And let's say that you can sell 100 shares of it for $8 a share. Okay, let's say that Ford goes down to $2 a share, but you have 100 shares of it. The contract says that you can redeem the contract at a rate of $8 a share. So if Ford is down at $2 a share, and you have a piece of paper that says that you can redeem your Ford for $8 a share, then that piece of paper is worth a lot of money. So with options, you can make money whether the price goes up, then your call makes money. If the price goes down, then the put makes money. And a way to do that is to straddle the stock by purchasing a call and a put. And one loses, the one that wins made you $20, the one that lost you $10, so you came out $10 ahead. And trying to explain it best I can. Now the expiration date is very important here because it defaults to November 20th, which is in 5 days. These contracts are cheap because they expire in 5 days. You really don't want a cheap contract. That one's 21, that one's 58, times 100, that's $21, that one's $58. Okay, let's go out with our expiration date to January 15th, which is 2 months. That gives us 2 months to purchase the option contract and then sell the option contract when it either goes up or goes down. Okay, now Ford is trading at shares of, now we're on January 15th, Ford is trading at $8.50. Okay, now this call down here is considered in the money because with a call, the ones underneath the share price are in the money. Okay, now this is the strike price here, $8, but we don't want to pay much attention to that. We want to pay attention to the break-even price. The break-even price is $8.91. So if you're buying a call here, to break even, the stock has to go up to $8.91 because you just paid $91 for the call option contract. Plus, the stock at $8.50 means that in order for you to make money on the call, the contract has to be above $8.91. So you're betting that it's going to go up to $9.25. It probably won't. We just looked at it. I would say that it's not going to do that. So let's look at the put. So we're going to bet that it's going to go down. Okay, now make sure your expiration date is January 15th, 2 months away. Okay, now with a put, we're betting that it's going to go down. With a put, the ones above the share price are in the money. The ones below the share price are out of the money. So here is a put, 100 shares, cost $84 right here. Okay, now looking at the break-even price, we're betting that the stock will go below $8.16, and then, which is down quite a bit, really, it's down 35 cents. So if it goes down to $7.50, or if it goes down 50 cents below that to $7.66 or 64 cents, $7.64, then you made 50 cents on 100 shares, you made $50. Okay. If it goes down to just $8, then you made 16 cents, or you made on 100 shares, or $16. So I don't feel that the Ford stock is going to go anyplace, really. And I think that would be a lousy bet either way. But just for the heck of it, let's click on this put right here. The red right here. Left click of the mouse there. And then we'll say it's a $9 put, costs $84. Continue. And then let's change this over here. You have good for a day. And good till canceled. Let's click on good till canceled. Review your order. Okay. Up here we've got to add 1 unit or 1 contract. Type the number 1 up there. Now we can review our order, or you can type 100 if you're a millionaire. But I feel that right now Ford's probably not going to do much of anything. It's right in the middle. Like, it's a long ways for the 850 is directly in between $8 and $9, so it's kind of a long shot there. And not to be confused with a long put, which is what we're doing. And so I personally would not buy either a call or a put on Ford Motor Company at this time, but we're only using it for educational purposes as an example. Okay, review. You're paying $84 for the right to sell 100 shares, $9 per share by January 15th. If the shares are not $9 or lower, January 15th, option will expire worthless. Okay, now, don't be fooled that if it's under $9 you're going to make money. You're not going to. If it's under $8.16, then you'll make money. But if it's under $9, then there will be a little bit of money. For example, if it's still on $8.50, then you'll get half of your money back. So anyway, we're going to cancel that. You just have to do, it's very simple math. It's kind of confusing at first. Anyway, so let's go to, then let's click out of here. I'll show you how to do that. We'll go back, and we'll hit this red X, and we're back on there. Let's go to the call here. And the computer is either slow or I've been eating. I don't know which it is. Anyway, probably probably both. Okie dokie. Now, and the money would be down here. $91 for the call. Betting that the option is going to go up. And we'll click back on it right there. Continue. One contract. Good till canceled. Review order. Now, we don't know what Ford's going to do. Nobody knows what Ford's going to do. It's $8.50. Like I say, this is Sunday night. Monday morning, it could be $10 a share, or it could be $6 a share. Nobody knows what it's going to do. It's probably nothing about the news. It's just an old, laid-back stock. It's been there for 100 years. Okay, you're paying $91 for the right to buy 100 shares of Ford, $8 per share, before January 15th. If the shares are not $8 or higher, the option will expire wordless. Okay, now, if it's $8.10, then 100 shares times 10 cents is you made $10. Okay, but you paid $91 for it, so the price has to be $8 above $8.91 for you to make money on there. And I'm not really too keen on making any bets on the price of Ford right now, and so I'm going to call that a lecture, and I'm going to call that a video, and I'm going to close this out here.